Let's talk about what an ETF or exchange traded fund is versus what a mutual fund is. Let's say your friend wants to open a hamburger stand. He asks you for money so he can get it started. In exchange for money, he'll give you a share of the company. That's a stock. By lending him money, you get a bit of ownership of the company, and in exchange, he gets money to build out his hamburger stand. Now, let's say you like the idea of hamburger stands and you want to buy a bunch of them from other people or companies and not just your friend. Or you want to buy a bunch of shoe companies, not just Nike, but you want to own a bit of Nike, Adidas, Pumas, etc. You can buy some Nike stock, some Adidas stock, and some Puma stock. Or you can just buy a pre-selection grouping of stocks. That's what an ETF or mutual fund is. It's just a collection of stocks. But what's the difference between an exchange-traded fund or a mutual fund? One difference is that an exchange-traded fund, or ETFs, can trade multiple times in the same day. For example, if you want to buy an ETF at 8 a.m. and sell the same ETF at noon, you can get in and out of the trade the same day and get nearly the price that you expect. You can sell the mutual fund in the day and instantly have the cash to buy another ETF or stock the same day as well. But a mutual fund only trades at the end of the day, around 4 p.m. Pacific time or when the market's closed. Let's say in the morning, the mutual fund is going up in price, but starts to tank or lose money around noon. You want to instantly sell the mutual fund at noon to lock in the price and avoid any more losses. But with mutual funds, that's not possible. Mutual funds only trade at the end of the day. So the price at the end of the day is the price that you get, and you never really know the price that you're getting with mutual funds. Also, mutual funds in general have higher management fees than ETFs. For example, a mutual fund might charge you 2% in management fees, whereas an ETF only charges you 0.03%. So if you make a 5% gain, you're really only making 3% with a mutual fund because of the 2% management fees. So with an ETF, you're keeping most of the profits. For these reasons, I'm not a fan of mutual funds, but unfortunately, the industry pushes hard for mutual funds to be in your 401k. So be sure to take a look at management fees when you make your 401k selection. To recap what we just heard, your friend wants to open a hamburger stand and he wants you to loan him money. So he will give you one share of his company in exchange for money. And if you want to buy a collection of hamburger stands from various people, you can buy an ETF or a mutual fund. So a stock is just a share of a company, and an ETF or a mutual fund is just a collection of individual stocks, like a collection of shoe stocks or a collection of car stocks. Here's a comparison of some of the differences between an ETF and a mutual fund. On an ETF, a trade executes when the markets are open, versus a mutual fund, the trade executes at the end of the day. On an ETF, a trade can be executed multiple times in the same day, versus a mutual fund, regardless of when you place the trade only executes at the end of the day. On an ETF, you get the price that you want on the buy and the sell. Versus a mutual fund, the price is unknown until the trade executes at the end of the day. In general, the ETF have lower management fees. Versus for mutual funds, in general, they have higher management fees. On an ETF or a stock, you can put a trailing stop loss. Versus for a mutual fund, you cannot put a trailing stop loss, so there's no downside risk protection. So let's take a look at what it means when an ETF can be executed multiple times in a day versus a mutual fund is only executed at the end of the day. We'll take a look at the left column. Let's pretend we buy one stock of Tesla at $10. And when the stock starts to drop to $8, we decide we want to get out. So we can sell one stock of Tesla at $8. We can buy and sell in the same day. So we got in and out of the trade and we were only down $2. Or we can get in and out of the trade and capture any profits that were made. Now let's take a look at the mutual fund column on the right hand side. Same scenario. You can buy one stock of Tesla at $10. You start to notice that it starts to tank to $8. You decide you want to sell one stock of Tesla. However, the trade does not execute until the end of the day or around 4 o'clock Pacific time. So the price is unknown on execution. The loss could be more than $2, or you also don't know what gain you've made because the price doesn't execute until the end of the day. Vanguard and other brokerages say that management fees eat into your returns over time, especially with mutual funds. And also trailing stop losses are on ETFs or stocks only. Let's take a look at the left-hand side for the ETF. You've made a profit of 5%. The management fee is 0.03%, which is the case for a lot of the ETFs out there. So your take-home profit is 4.97%. Now let's take a look on the right-hand side. You've made a profit of 5%, but the management fee is 2%. So your take-home profit really is 3%. That's a big difference between a 4.97% profit and only a 3% profit. Takeaways from this episode: choose the lowest management fees possible, and if possible, sell the mutual fund and buy a similar ETF. You can watch video 5 for a selection of ETFs. That way you have more flexibility with your investments and you pay less fees. In a later episode, I'll show you how to put a trailing stop loss on your stock or ETF, which I think is the most powerful trading tool out there. Most people want to get started in investing, but they don't know how. I put together simple, practical, and step-by-step videos on how to get started. Watch this video series and contact me to kickstart your wealth.